All right, ICT traders, welcome back to the channel. Just a very quick one right here. I want us to go back into the very basic of what exactly is liquidity, what is inducement in the ICT concept. This is very important because without having this understanding, you make a lot of error. Of course, trading has to do with a lot of guesswork, but make sure that anytime you're doing a guesswork, you have an intelligent guess towards what you're doing. The market is full of intelligent minds out there, and that is why you need to have an understanding of what I'm about to show you. What exactly is inducement, what exactly is liquidity, and why does it happen? So let's go into explaining this simple concept. So let's start from liquidity. What exactly is liquidity? Liquidity is simply money in the market. All right, it is simply money, and this money, it is in form of people's stop losses and stop orders. All right, either buy stops or sell stops. And then inducement, as you can see right here, inducement is basically a manipulation that happens in the market in order to grab people's money or to snatch people's money. Every time you hear the word inducement, you can replace it with the word deception. All right, it is basically when smart money go ahead and grab your stop losses that you've put in the market. All right, I have a sketch right here. I'll go to the chart and show you everything in detail subsequently, but let's go through this particular sketch and then we go to the practical aspect of what exactly is liquidity and inducement. So look at this. This is a typical example of a downtrend. Bringing in every ICT concept, you know, price has just reached out to where? To this area. And normally, if you're trading ICT concept, what do? You wait for price to retrace. Now, the reason why you get caught up in inducement is mostly because of early trade entry. Early trade entry. If you have a futile understanding of what exactly is institutional reference points or where institutions are most likely going to take their trade, you will always be a victim of inducement. So look at this typical example. Price just reached this area, picking this one. Mostly traders are impatient. All right, you bring your fib level from this swing high to this swing low, and then price just retraces not even up to 50% of the Fibonacci level, which is supposed to give you a certain level of confidence when you have at least above the 50%, because this is the Fib level according to ICT that is called equilibrium. Anything above here is called premium. So if you are selling in the market, you want to see price come back to premium, and then if you are having a bullish run, you want to see price come to discount. So below this 50% is called discount. So whenever you are taking trade in this area and then you are leaving a point of interest above where the institutions have a high chance of reaching in order to get a better price, everybody is in the market to make money. Likewise, and then we know the smart money don't want to lose. All right, so they will do anything as much as possible to make more money. And as you can see right here, I've given several examples before of why you don't want to be selling around this area. I've given you an example with this orange seller. Imagine you are selling an orange from this level and the orange is being sold at $100 per one. All right, imagine the price dropping to this place and the orange price now dropped to $10. All right, do you think you're going to feel comfortable with selling it here? Obviously, you will try as much as possible and hide the orange so that the scarcity will create demand, and then the price will go up, will go up, will go up, will go up to maybe $90, and then you sell again. And that is exactly what is happening here. All right, that is exactly what is happening here. So those people that were basically selling here because they just saw the price went up to $30, right, from $10, and because of what we call FOMO, fear of missing out, all right, FOMO, they will now be too quick to start going for the sell. All right, and then when you sell here, where do you want to put your stop loss? Above here. All right, and anytime you put a stop loss for a sell order, if you take a sell from here, let's say price is coming like this, retracing. If you sell from here, your stop loss is obviously going to be just right above here, except if you are trading without an understanding of money management. All right. So if you sell from here and then you put your stop loss here, you're basically telling the system that in case price did not go down, I want to have my position close at this area. So if price is coming up, I want to buy at this point. So you sold at this point, all right? And then your stop loss is a buy order. Don't forget this. So your stop loss is a buy order. You're actually buying it expensively from somebody that is selling above you. I hope this explanation is perfect enough. So every time you just see price do this and then you take the sell here, other people are selling here, people are selling here, people are selling here. All this area is filled up with liquidity. Remember, I told you that liquidity is simply people's stop losses. So this is what liquidity is, because as soon as you see price creates a high, what do you think is here after price has retraced? It is money that is going to be there, and money in form of what? In form of stop loss. All right, in form of buy stops, in form of stop losses. And if price is going up, what do you think price is going to grab? Liquidity, money, people's order. All right, that is exactly what price is doing, and that is the reason why you get stopped out sometimes. So as soon as this institution sees this liquidity pool of liquidity, ocean, blue ocean of so many stop losses, money, they will now manipulate the market. Boom. And this is inducement. All right. Inducement. They will manipulate it, allow the market to push up so that you can buy expensively. They can make more money. And as soon as they see more people are buying, because a lot of people don't even know what they are doing in the market. As soon as they see this, what do you think they are going to think? Breakout traders will see this as an opportunity to what? To start. Let me delete this so you can see what I'm about to show you. Breakout traders will see this as a breakout, and a lot of them will start buying. They will start buying. If you're a breakout trader, you see a range. Oops, price have broken a resistance area at this point, and then you start buying, and they are looking at this point of interest where they want to sell, and then boom, they sell it for you at an expensive price. A lot of people get to buy it at that point, including those ones that have bought at this point with their stop losses here, creating a lot of inducement. So you can see this happening in different ways. You can see it in the form of channel. All those pattern traders, you will see it in form of channel. You see this breakout, who now sell, you sell, boom, you get inducement at that point. All these places is filled with people's stop losses, reaching out for the point of interest. Notice how price will always look for the extreme area where there may be a valid institutional reference point, maybe an order block, or maybe a fair value gap. All right, so this one happens again, boom, happen like that. Let me show you that in a practical example. I don't want to go far with that. So look at this. As you see, price just came to this area. We are going up, we're going up to this area, and we have a shift in market structure, around this area. Can you see where my cursor is? As price went up, there is a shift in market structure here. The market moves in fractal. All right, you will have series of break of structures, shift in market structures. Shift in market structure is simply when price just decides to change direction completely from one direction to other, and that can be seen. You can check my videos in order to learn this. And those of you who are starting out with ICT concept as beginners, this YouTube channel is completely dedicated to ICT beginners. I'm going to place the link to this particular YouTube channel in the description of this video. All you have to do is to come here. Everything is arranged for you in such a way that you can learn it stress-free. We have the beginner level, intermediate, and then advanced videos. So this is dedicated for beginners. You watch the videos in such a way that you will learn a lot. So look at this price shifted structure in this exact location. Let me show you that from here. All right, as price was coming down, we have a shift in structure. And what do we normally do? We look for a valid institutional reference point. Right above here is an order block, all right, bearish order block, this small candle, and then right here is a fair value gap. So what do? You want to take trade. Normally when you see a very big fair value gap, according to ICT, you would use something called consequent encroachment. You will measure the entire fair value gap and take the middle of that fair value gap as the ideal point for trade entry. And let's play it out and show you. Those of you that are too quick to take trade, you see now, look at this. Look at this. With your fib level, you put from here to the swing low right here. As soon as you see price touch this fair value gap, yes guys, let's enter the trade for the sell here. Boom, you're entering for the sell. And of course, you will not be that foolish to put your stop loss up here. It's big, right? You want to put it somewhere maybe above the consequent encroachment, just to target maybe the recent low. Quick entry, FOMO, fear of missing out. As soon as you see these other black candle prints or the bearish candle prints, you want to get into that trade. And not only you, hundreds of other uninformed retail traders are taking that sell position from here, and their stop losses is just filled up here, pile up here. All right, they are watching it, and the smart money will be patient with you to see how price. You are happy already, prices. Some people are even adding their positions, and then boom, you get inducement. All right, you get inducement reaching out for this area, and then price is crashing down to this level. All right, you can see the exact definition of what inducement is. So why did this happen? That is the question. Why did this happen? Now, a couple of things right here. Price reached out to this area. We are taking the trade at the wrong position. I think this is more of a discount area. It just touched the tip of this very big fair value gap. It's a very quick entry. Sometimes, because you don't want to miss out. What if you miss it? Nobody promised you that trade is going to be always rosy. You're going to have wrong trades. You're going to have good trades. The beautiful part of it is that whenever you have a wrong trade, you lose little. And whenever you have a winning trade, you win more. All right. So imagine taking trade here. Isn't it risky? Because you saw price take out this high, and then boom, you have that. So as soon as some people see this taking out, this is a range to some people. This place, this is a range. Or traders that are trading patterns, this is a range. Breakout. They see this happen and they say, this is a breakout. Let's buy. All right. So two types of people are caught up in this. They buy, and boom, it is sold to them. Likewise, those people that have stop losses, here they get into this trouble and mess. And look at how price came right above here, filling up this liquidity void. The market is simply designed to balance every single imbalance that is in the market. You see this very big candle? No matter what will happen, price will have to balance it. Anytime you see a big candle, price will balance it. Anytime you see a big candle, price will balance it. Anytime you see a big candle that prints, price will balance it in the opposite side. This is what ICT calls liquidity void. Liquidity void. All right. Do you know that you can also consider this as an inducement? This area. This is an inducement. Inducement, because some people have sold it right here after they saw price print from here. All right, from here to here. Now notice how the people that were selling from here were just entering without paying attention to the liquidity void right above here, just like the liquidity void right here. So two things to look out for whenever you want to avoid inducement is to look out if there is a valid institutional reference point right above the area of inducement or the area where the liquidity is gathered, the liquidity pool, just above this high and then above here. If there is a valid institutional reference point, then you are about to march on a landmine. So be careful with that. So look at it, boom, price inducing that area. So let me just be quick to show you more examples, and then you're going to see how to avoid it in reality. So let me see this. All right, look at this. Another example is this. Look at this. We have a break of structure to the downside right here. Price just pushed from here to here. All right. Quick entry right here. People that see this slow in this retracement. Imagine somebody here is taking the sell prior to that area. Is taking the sell right above here. Probably because you see price came into this fair value gap and then you're taking the sell right here. Number one, you are taking the sell in a discount area, and then number two, there is a liquidity void right above here. That is why you're wrong. You're just taking the trade very early, and let's see, boom, you got stopped out. You were used as an inducement. Remember the sketch I did? There are some of these you will see just above here. All of this area is filled with liquidity, so price will obviously grab it and get you out of the market, and you will see it going in that direction. I have been a victim of inducement severally, so it is not only you. You have to keep practicing, and the psychology of trading will help you to now avoid inducement over time. All right, so look at this guys, just look at this. Price came having this shifting structure right here. This is a shifting structure to me right above here, and if you're measuring this from here to here, you have this. All right, you have this. Do you know that there are some people that have entered the trade right here? This is a buy model. All right, so these guys that have entered the trade right here, it's too early. Remember I told you number one is early entry, maybe in a discount or a premium area. Especially if you are selling, you want to see price come to premium before you sell, and if you're buying, you want to see price come to discount before you sell, and discount is basically just below the 50% level. So look at this. There is a liquidity void, these very big candles, and then price was just targeting this area. So all this place was filled with people's stop losses. They were happy that this trade is actually going in their direction, and then boom, they got stopped out. The people that are seeing this as a range breakout, they are selling. All right, they are selling rather. They got stopped out too, and that is the greatest unbecoming of trading. So if you go through your chart, you're going to see this time and again. I wish there is a way I can just explain the way I'm explaining in a fewer terms, but sometimes trading involves taking time to explain these things. I have been a victim of, look at this price coming, shifting structure here. You can see price pushing above it, taking into this fair value gap before pushing down. So all these people that were selling from that area, you need to have a strong level of psychology. It's better to have your money in pocket and not to take trade than to take trade and still lose it. All right, so that is why sometimes we want to be careful with taking trades so that we don't become inducement or we don't get manipulated. The moment I saw this happening, I know that once I saw this, inducement will come, price will now have to come back to this area. All right, so taking trade in this level is actually you attracting the attention of smart money to bring inducement your way. All right, so let's go and see if there are more examples. I will be stopping from here, and then I will make more examples. If you have any question, I will spend time and teach more and more and more of these for you guys. Don't forget guys to give me a like on this video, and don't forget to share with your friends, your colleagues. If you have any question, let me know in the comments. Thank you guys for watching. See you in my next video.